Good day, investors. In this video, we will take a look at one of the most popular dividend ETFs in the entire market, the Schwab US Dividend Equity ETF, also known simply as SCHD. For many investors, SCHD has become a core long-term holding, and it's easy to see why. The fund combines solid dividend income, strong dividend growth, and exposure to high-quality companies, all while charging one of the lowest fees in the entire ETF industry. And for investors who are building a long-term dividend portfolio, SCHD can play a very important role as a stable foundation for generating both income and long-term returns. So in this video, we are going to look at why I believe SCHD is still one of the best ETFs to hold for both dividend income and long-term portfolio stability. But before we get into it, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming investing videos. Thank you very much. So first, let's take a closer look at what SCHD actually is and how the ETF works. SCHD tracks the Dow Jones US Dividend 100 Index, which focuses on high-quality American companies that pay strong and sustainable dividends. Instead of simply selecting stocks with the highest dividend yield, the index uses a screening process that focuses on financial strength and dividend sustainability. Companies are evaluated based on factors such as return on equity, cash flow relative to debt, dividend yield, and dividend growth history. Only companies that meet these quality criteria are included in the index, which helps ensure that the ETF holds financially strong businesses with the ability to continue paying and growing their dividends over time. Today, SCHD holds around 100 companies, giving investors a well-diversified portfolio of large and established businesses. Another major advantage of SCHD is its very low expense ratio of just 0.06%, which means investors keep almost all of their returns instead of paying high management fees. And this is one of the reasons why SCHD has become such a popular ETF among long-term investors. You essentially get a portfolio of high-quality dividend companies with broad diversification and extremely low costs. So now let's talk about one of the biggest reasons investors are attracted to SCHD in the first place, the dividend. One of the key advantages of SCHD is that it offers a very attractive balance between current income and dividend growth. At the moment, SCHD offers a dividend yield of roughly 3.4%, depending on market conditions. That is significantly higher than the dividend yield of the Vanguard S&P 500 ETF, which is closer to 1.15%. But the real strength of SCHD is not just the yield today. It is the consistent growth of the dividend over time. Over the last several years, the ETF has increased its dividend regularly, which means that investors who hold SCHD for the long term can see their dividend income continue to grow year after year. This is one of the most powerful aspects of dividend investing. Instead of simply receiving a fixed income stream, investors benefit from rising income over time, which can help protect purchasing power against inflation. And because SCHD focuses on companies with strong cash flows and healthy balance sheets, the companies inside the ETF are generally well positioned to maintain and grow their dividends in the future. And as mentioned earlier, SCHD holds around 100 dividend-paying companies, which gives investors a well-diversified portfolio of large and established businesses. Some of the largest holdings inside the ETF include companies such as Lockheed Martin, Chevron, Verizon Communications, Coca-Cola, Merck, and AbbVie. Together, the top 10 holdings account for a little over 40% of the total portfolio. These companies tend to be large, profitable businesses with strong cash flows, which is exactly the type of company you want in a dividend-focused ETF. For example, the portfolio has an average return on equity of around 27%, which suggests that many of these companies are highly profitable and efficient at generating returns for shareholders. The ETF also trades at a price-to-earnings ratio of roughly 17, which is fairly reasonable compared to many stocks in the broader market. Another important aspect of SCHD is its sector diversification. Unlike many ETFs that are heavily concentrated in technology stocks, SCHD spreads its investments across several sectors of the economy, including energy, consumer staples, healthcare, financials, and industrials. This diversification helps reduce risk because the performance of the ETF is not dependent on just one sector. Many of the companies inside SCHD operate in stable industries that generate consistent cash flows, which helps support their ability to pay and grow dividends. Because of this, SCHD can often provide more stability during periods of market volatility, which is one of the reasons many investors use it as a core holding in a long-term dividend portfolio. And another important aspect of SCHD is its long-term track record. Over the years, SCHD has delivered strong total returns while also providing a growing stream of dividend income. This combination of income and capital appreciation is exactly what many long-term investors are looking for. But what makes SCHD particularly interesting is the role it can play inside a broader portfolio. For investors who already own growth-focused funds like the S&P 500 index or technology-heavy portfolios, SCHD can act as a balance to those positions. Because SCHD focuses on dividend-paying companies across multiple sectors, it can help provide stability during periods when high-growth stocks become more volatile. At the same time, investors are still receiving a steady and growing income stream, which can either be reinvested to compound returns or used as passive income. Right now, SCHD is trading at around $30.87 per share, and the ETF is up about 11.7% over the past year. Recently, the ETF has been in a steady uptrend, and it is currently trading not far from its 52-week high of around $31.95. SCHD currently pays an annual dividend of about $1.05 per share, which is distributed to investors on a quarterly basis. At current prices, this translates to a dividend yield of roughly 3.3%, providing investors with a steady income stream while also participating in the long-term growth of the underlying companies. So overall, when looking at the bigger picture, I think SCHD remains one of the most attractive dividend ETFs for long-term investors. The fund combines a solid dividend yield, consistent dividend growth, and exposure to high-quality companies, all while charging an extremely low expense ratio. At the same time, SCHD offers investors broad diversification across multiple sectors, which can help provide stability during periods of market volatility. And for investors who are looking to build a long-term dividend portfolio, SCHD can be a very strong candidate to consider as a core long-term position to continue accumulating over time. Over the long run, the combination of dividend income, dividend growth, and reinvestment can create a strong foundation for building long-term wealth. If you found this video helpful, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming investing videos. And as always, remember to do your own due diligence before making any investment decisions. Thank you for watching, and happy investing.